Hey, welcome to the Driven Billionaire channel. From the government's interference to Elon Musk's tweets, in this video we are going to show you 5 reasons why the crypto markets are so volatile. Make sure you watch the video until the end. Number 1 is the greatest reason why crypto markets move a mile a minute. A disclaimer alert is now in effect. This video is for informational purposes only. We recommend you to always seek professional advice. Number 5. Government interference. Whether it is the Chinese government banning crypto mining, or even banning people using it, to a new law in Kentucky that will provide tax exemptions to cryptocurrency mining operations. Government interference can influence the decisions of investors all around the world, which leads to movements in the markets. However, when we talk about new markets, such as the crypto market, a single government decision can make prices go crazy high or low. For example, in the past month, we have seen China banning crypto mining and cracking down on operations, which has pushed crypto markets to go down even further. Nevertheless, just like any other market, you can have government actions which will have none to very little influence in the markets. A good example of that is the recent adoption of Bitcoin as El Salvador's legal currency, which was largely ignored by the markets. Even so, if you are looking to invest in cryptocurrencies, or if you own crypto, make sure to always be aware of what major government policy and actions are taking place. They can move prices and change investors' feelings towards crypto, but as long as you know what is happening, we can guarantee that you will feel more comfortable with the market's movements. Number 4. High inflation. With economic crises and devaluation of the dollar and other currencies, investors are looking to get into cryptocurrencies and gold as never before. As a result of governments around the globe printing more money to give out as stimulus packages, investors and specialists expect a hyperinflation to soon hit economies such as the US, and this means that currencies like the dollar can have an enormous drop on its value. In order to avoid this, investors tend to acquire assets that are more secure even with the devaluation of the dollar, such as commodities and cryptocurrencies. But wait, how does that make the market more volatile? Well, the weaker or stronger currencies get, such as the euro or dollar, the more investors buy or sell their commodities or cryptos, which leads to the drastic movement in prices. Also, it is valid to mention that one of the key selling points of cryptocurrencies, such as Bitcoin, is that it has a limited amount of tokens. This makes it inflation-proof since no institution or government can produce more tokens. This makes crypto attractive to investors because no matter how bad inflation gets, they can always be safer by trading crypto. Number 3. Technology is still being developed. The concept of cryptocurrencies has barely been around for 10 years, and as blockchain and other alternative crypto technologies are still in the early stages of development, it will be a while before the crypto market matures. Many companies have already adopted blockchain technology and are actively using it for marketing and advertising purposes, with promising projects such as ADEX, Brave, and Steam. As this technology evolves and more companies adopt it, cryptocurrencies gain more credibility among investors, which tend to get into the crypto market, driving prices upwards. Nevertheless, even though many companies have already adopted blockchain technology and are actively using it, stubborn technological hurdles like the blockchain scalability problem can cause downward pressure on crypto prices. This happens when the problems aren't solved in the time frame that many investors expect, or when their consequences become real in the form of network congestion and high transaction prices. Just like any other technology, after the creation of Bitcoin, other cryptos were created in order to compete and take some market share for themselves. This is good for the crypto market, as with more cryptos accommodating investors' wants and needs, the crypto market is more likely to grow in general. Remember, a high tide raises all boats. The more that investors buy and trade cryptocurrencies, the more value the crypto market will have. Number 2, speculation. For sure, one of the biggest drivers of volatility in the cryptocurrency market is speculation. This involves traders buying and selling cryptocurrencies by betting on the rise or fall of the prices of the cryptos they have bought. In fact, the volatility of the crypto market is what attracts speculative traders that are looking to make money by trying to predict where prices are heading. For example, if you can pick when the price of Ethereum or Ripple will move upwards and buy right before it does, you can make a killing. Similarly, if you can sell a cryptocurrency right before it crashes, you can profit too. Traders are constantly trying to guess the ups and downs of crypto prices, and these speculative predictions cause even more fluctuation in an already volatile market. In addition to traders' speculations, the media has a massive impact on where the prices go as well. Speculators and investors are constantly looking for the headlines or the next big news story that will launch or crash the market. When something does emerge, everyone knows it's a race to buy or sell, and the fastest one to do it will profit the most. However, it doesn't help that many investors in the cryptocurrency market get their news from questionable sources, such as social media. At the end of the day, many of the news stories that come out about crypto shake up investors' feelings, and that also leads to a more volatile market. Number 1. Market euphoria. Doesn't matter what you invest in or what assets you have, we can guarantee that you have already seen this before. Whenever there is a market which becomes very popular all of a sudden, you have people that jump on it just because of what their friends told them. On the other hand, you also have those who, when the markets crash, jump out because of what they hear on the news. You know, those people who like to buy when the prices are high or sell when the prices are low just because of the euphoria of the moment. Exactly. More often than not, you see amateur investors that are eager to jump on the next big thing so they can make some money. A great example is what happened with GameStop and Reddit, where many people jumped on the euphoria and bought GameStop stock. In the crypto market, this happens all the time, Dogecoin being the prime example, especially when Elon Musk tweets about it. However, this euphoria does move the markets in real life. It affects investors' decisions, prices, and people make or lose money. In the end, the volatility of the market is largely due to investors' feelings towards it. It is that simple. So let's summarize. Prices go up and down because people are buying and selling crypto, so they gain or lose value. But if there is a euphoric feeling in the market, the volume of orders is so great that prices can burst upwards or crash. We hope you've liked this video, and if you did, please smash that like button and subscribe to our channel. Also, if you like this video, we highly recommend you watch our video on the 7 cryptos with potential to grow. See you guys next time. Take care.